Hello, greetings, and welcome to Dividend Blasters. This is our 45th video. The topic today is invest now in this dividend superstar, Devon Energy. Ticker symbol DVN. Yep, it's an oil and gas company. And I am an investor, and I couldn't be happier. As we press on, let me first give a disclaimer. I'm not your financial advisor. The purpose of this video is for information and education. It should not be taken as financial advice. It reflects my own personal opinions, my research, and my experience as an independent investor for more than 30 years. So I urge you, do your own research, do your own due diligence, and consult a financial advisor prior to making financial decisions. First, let me thank you for joining us here at Dividend Blasters. I would kindly ask you to give this video a like. And if you're not already a subscriber, I'd kindly ask you to consider subscribing at the end of the video and sharing the video with a friend or a family member. So, what is Devon Energy? They're an energy company. They explore for, they develop, and they produce oil, natural gas, and natural gas liquids in the United States, operating in Delaware, Endarco, Williston, Eagle Ford, and the Powder River Basin. Some metrics. At the end of 2022, daily production for barrels of oil, 315,000. For barrels of natural gas liquids, 150,000. And more than 1 billion cubic feet of natural gas. Their portfolio of oil and gas properties that I just mentioned provides stable, environmentally responsible production and a platform for future growth. That's really important, future growth, especially for us long-term investors. They were incorporated in 1971. They are headquartered in Oklahoma City, Oklahoma. And here's a map of their U.S. operations that I just mentioned. So, what is their business strategy? So, this comes right from their annual report. And what I like about this is that they are very focused on us, the investor. First and foremost, they want to deliver a consistently competitive shareholder return. Number two, they recognize that this business of oil and natural gas exploration, development, and production is capital intensive. They have to deliver sustainable, efficient cash flow growth. It's key to their success. They recognize that, they plan for it, and they manage it. They also recognize, number three, that cash flow is highly dependent on the price of oil, which is volatile, it's uncertain. And their strategy embraces that. These are their four governing principles that incorporate these first 3 points. They strive to be a proven and responsible operator. They take to heart the interests of stakeholders and environmental, social, and governance values. They own a portfolio of assets across the United States that are second to none. They manage them to generate recurring, growing cash flows that have to be in excess of their capital and operating requirements. They got to be competitive. How they execute has to be second to none, has to be superior. So they're always working to optimize how they allocate their resources to their capital programs and their production. They absolutely have to be very stringent on managing unit cost to enhance those returns. It's a very, very competitive business. They also think of their workers, the health, the well being, the safety, as well as our environment. And then, last but not least, financial strength and stability. This is really important if you're an investor because they're looking at the numbers and we are looking at the numbers. They're looking to maintain strong balance sheet measures. So, liquidity, what does that mean? That's cash. All right. It's the lifeblood of a business enterprise. Cash. They got to have financial flexibility. They got to be able to operate competitively across all price cycles of this business. It's a boom or bust business, and it's very dependent on the price of oil. These capital allocation decisions are made with these principles in mind. They got to be able to prioritize how they're going to fund their resources around their operations. They're looking to protect their investment grade credit rating. And, and this is very important, last part of the second sub bullet, pay a growing shareholder dividend. And they do it. Here's a graphic I got from Yahoo Finance, and this really speaks to that price volatility of crude oil. And this basically shows that it's been up and down the last 20 years. As of yesterday, the price of a barrel of crude oil is $73.67. You can just see that, over the last year and a half or so, it had gotten up over $100, probably around $120. Go back before 2010, it was approaching 150. Go back to 2020, it was down below 40. So it's up and down. And to be successful in this business, you got to be able to manage the ebbs and the flows of that resource. Here's a graphic also from Yahoo Finance, shows a little bit of that volatility just over the past year. It's really nothing different. Still got a lot of volatility. How do you manage that? I'm adding a couple articles. You can read these at your leisure, and this speaks to the volatility. This is an article from Forbes back in February, and it's called "Why is the Price of Oil Rising?" Major takeaway here is that OPEC had signaled that they were going to cut oil production, and when they do that, it tends to drive the price of oil up. You can read this at your leisure, but there it is. And then, of course, another disruption has been the Russian Ukraine war that's been going on. All right. And then, here more recently, this was an article, an interview, a video interview on CNBC with Citi's Ed Morse. And he is the global head of commodities. And he's predicting, and it's kind of hidden in there, he's predicting basically steady price of oil, but he sees it going up. They have a target price of around $82 in Q3. So something to look out for. And another interesting article, and this speaks to basically institutional investors and their interest in the big oil companies and small oil companies like Devon. Uh, and they speak to a couple here. Rockland Trust has been increasing their stakes in Devon just recently. This is an article from the Ticker Report just a couple days ago. And then Clearview Wealth Advisors as well as Canada Pension Plan Investment Board. So just interesting. Some of these institutional investors are also taking a close look at Devon. To me, that's a good sign for us smaller independent investors. Summary metrics. The price is sweet. It closed yesterday at 48.85. I will draw your attention to the forward PE ratio of 8.11. It's much less than the Dow Jones 22.5 or the S&P 500's 19.69. Let me manage your expectations. Really, every oil and gas producer has much lower PE ratios than the larger market. What really makes sense is to see how they stack up against each other within their market sector. And I'm going to show you that in a little bit. But it's interesting. Look at the forward dividend yield, 1.64% for Devon. That is more than the S&P 500's. However, it is less than the larger Dow Jones Industrial, a little bit. Not a huge company, but a good-sized company. 31 billion market cap. It's probably 1/8 the size of a Chevron or an Exxon Mobil, so they're much smaller. I mentioned the forward PE ratio. This is the trending 12-month PE ratio, which is even less. You can actually see it coming down over the last year. It's around 5.32, and that's quite a trend downward. But a lot of the oil and gas producers, their prices have been coming down as the price has been coming down. Price return. Well, let's take a look. Let's take a look at year to date. Well, price return is down. They are negative, less than 14, negative 14% about for year to date. When you look at max, which is 25 years, it's way up. It's 235%. Not quite at the 20, what is that? 2010 level. I think that's what that is, 2009 level. But it's approaching it. So, anyway, that's just price return. But you know what? We're dividend investors. I, as a dividend investor, am looking more closely at total return. Total return is price appreciation plus dividends. So, guess what? Total return year to date is still down. A little bit less because dividends basically dampen that a little bit, but not enough. But I'm looking at long term. Total return is for the last 25 years has been 335%. It's an increase of 100% over um, just the price return, which was 225%. So not bad at all. This is how Seeking Alpha grades them on a dividend scale. They get a B plus dividend safety. Basically, they've been doing it and they've been increasing their dividend for 5 straight years. The payout ratio is not bad at 64%. I typically like to see something a little less than 60, but it's close. Dividend growth, they get an A plus. No surprise there. You look at that 5 year CAGR, it's a little under 24%. Dividend yield is modest. I mentioned that the forward yield 1.64%. It could be more, but they do make up for it with their CAGR. Okay. I'm going to get even deeper into that with the growing dividend. Okay. They've increased it the last 5 years, but I'm going to talk more about growth. It's not just the growing dividend, but they do something called special dividends. I'll get more into that in just a little bit. Dividend yield, I already talked about this. Yeah, it's modest, but it's really less important than the CAGR. And this is really more important. It's the dividend growth. They get an A plus. I'm looking at the dividend growth rate for the trending 12 months. They get a B plus. You can see the percentage, it's 89% versus 36% for the sector median. Look at the 3 year CAGR. It's about 26%. It's more than 6 times more than its competitors and peers. Look at the 5 year CAGR, a little under 24%. It's about 6 times as much as their peers and competitors. If you look at the graph to the right, you can see how that yield, the actual yield, has been growing over the last 5 years. Very nice. You'd like to see those things pop up, and that's what it's doing. So, if there's a major takeaway from these slides, it's around dividend growth. It's the CAGR, the CAGR, the CAGR, or the compounded annual growth rate by the dividend. And if there's a little saying, and it's a take on a movie, Always Be Closing from Glenn Ross, it's always be growing. ABG, always be growing. If you have an investment where you're getting a sense that they're going to cut that dividend, my suggestion, this is not advice, but my suggestion is you cut it loose like a bad habit. You get rid of it because who wants an investment that isn't growing? You don't want a dividend that isn't growing. You're already giving up some price appreciation, maybe for some price volatility, but you got to have that growing dividend. Always be growing. All right. So here's their peers and competitors. So you can see Devon Energy to the left. You got a market cap of about 31 billion. I already mentioned that. 1,800 employees. Who are their peers? Well, Seeking Alpha says it's Diamondback Energy, and it's Hess Corporation, and it's Woodside Energy, and it's Coterra, and it's Marathon Oil. Let me just tell you at the get-go that with the exception of Coterra, none of these other investments pay special dividends. What is a special dividend? Let me tell you. Last couple of years and this year, Devon has been paying its quarterly dividends. So 4 quarterly dividends last year, for the year before, plus 4 special dividends each quarter. So instead of just getting 4 dividends last year and the year before, I got 8. Right? That's what shareholders got. This year, instead of two quarterly dividends through Q1 and Q2, I've already been given four dividends. So Q1, I got a quarterly and a special. Q2, I got a quarterly and a special. Coterra does that. That's a practice of theirs. Coterra is a little smaller. They're a little newer. Devon's been doing this a while longer. So right then and there, I'm telling you, I'm kind of giving you a heads up that this is where I am with Devon versus its competitors and its peers. Okay, let's press on. So they closed at 48.85 yesterday. Diamondback is about 2.5 times more price wise. Hess uh, about that as well. Woodside is about half the price, as is Coterra, as is Marathon. Price by itself doesn't mean much. You have to look at things like earnings as well. So let's look at total return. I got to tell you, that 3 year and that 5 year total return are the ones I look at closely. In 3 years, Devon's number one. For 5 years, Hess is number one, and Devon is number two. For 10 years, I'll tell you, Diamondback is number one, Hess is number two, and then Woodside and Devon are number three. Okay. And you know what? I'm not even looking at the year to date or the earlier ones because every one is down um, for total return. With the saving grace of price volatility is those dividends. And as long as this company is healthy and they got good, healthy cash flow and a good practice of paying a growing dividend, it's a good investment. So, how do they stack up dividend wise? Well, I already mentioned that the dividend yield is modest, but let's look at the average 4 year dividend yield. All of a sudden, it's much closer. They're right there with Woodside, and everyone else is way behind. Well, how does that happen? Diamondback and and Coterra, and they have a higher forward yield, but the average yield, no, because Devon is making it up with uh, the growing dividend rate through the cagr plus the special dividends. That's how they make it up. That's how they manage it. I'll tell you what, I do like their cagrs. Look down below. I would say that the 3 year cagr is competitive. It's a little bit less than the others, except Hess, it's way above theirs and it's above Coterra's. But the 5 years, it's right there. They're really tied for number one with Woodside and with Coterra. Look at the consecutive years of dividend growth. Well, they're at five, Coterra's at six. Okay. So, one thing I'll say is there is no one metric that's going to basically say, aha, that's it. They win this metric. They're the best investment. No, it's more complicated. You got to do a little digging. You got to do a little more analysis to get to the ground truth. That's what we're doing here. This is where they really set themselves apart. And this really, to me, gets us to ground truth with Devon. I talked about the dividend history, and I downloaded this from Seeking Alpha. You can see in 2021, they paid for quarterly dividends, but they paid for special dividends. A lot of these other companies, they just pay quarterly, or some of them pay just a couple of semi-annual dividends. These guys are paying 8 dividends. So they did it in 2021. They did it in 2022. In 2023, they've already done it for the first 2 quarters. They're continuing this practice. It's fantastic. Dividend grades. Well, I tell you, I would eliminate Hess right now because that dividend yields an F. I don't like it. I don't like to see an F grade anywhere. These are grades from Seeking Alpha. I will tell you, I like Devon and I like Coterra. Hess is good except for that yield. Woodside has one nice grade, the yield, but they're not managing the safety and the growth well. So I would take them out. Hess I would take out because of the F grade. Diamondback, they've got a low yield and the consistency isn't good. Marathon, they have They don't have a good yield grade or consistency. So right now, to me, it's it's Devon and Cotera right now. And I have mentioned that Devon's a little bigger and they've been doing it a little longer. So valuation, I'm looking at the PE ratio here. You know what? They all have decent PE ratios. The prices are fairly depressed. As long as they have steady growing earnings, steady growing revenue, steady growing cash flow, um, I'm fine. I'll tell you, when I see though a PE trending 12-month ratio of 20 for Hess, I say no. When I see a forward PE ratio of 27 for Hess, I say no. So I take them out. Woodside, there's not enough information here. Um, Coterra, not bad. They're some of the PE ratios are about the same. Marathon Oil, they're about the same. So anyway, this one's a little inconclusive. Profitability, everybody's profitable, but to me, where Devon sets himself apart is return on equity, return on assets, return on capital. They're the market leader here by far, by far. I like their cash flow. Okay, 8.37 billion. Woodside's is good, 8.81 billion. Those are the two market leaders for cash flow. Revenue per employee, it's Devon, 10.49 million. Okay. Um, Net income per employee, well, these are small companies. A lot of them are around 1,000 employees. So you're basically looking at 3 and 4 million for Coterra, Devon, and Diamondback, and then the rest are less. Price performance, this is less important to me, but for 3 years, it's Devon. For 5 years, it's Hess. For 10 years, it's Diamondback. And year to date and everything before, it's basically negative. So this slide is not as important, but I wanted to show you here that this is something that's looked at, but to me, it's not that critical. It's more total return rather than just price return. Risk, well, this speaks to price volatility. And I'll tell you, I am looking at the betas, okay? And I'm really looking at the 24-month beta. If you recall, and I've defined this in previous videos, that beta is price volatility of the larger market or the S&P 500. So a beta of 1.0 is the price volatility of the S&P 500. 24-month beta for Devon is 0.99. That's fine. They're less volatile than the general market, as is Hess, as is Coterra, as is Marathon. Diamondback's a little above. Woodside, I don't know what's going on there. That seems bizarre. But you know what? If I'm looking at trends, I would like to see the betas come down. When I'm looking at Coterra and I see that beta going up, I get a little skeptical. All right. Major takeaway is decent beta, less than 1.0 here. Income statement, well, you know what? Devon has the best revenue figures of anyone. The net income, I would say it's Woodside and it's Devon. They're both about the same, a little over 6 billion as his gross profit of 10.47 billion. Operating income, both about 8 billion. It's really between those two for income statement. Balance sheet, well, I'm looking at some of the ratios and I want to see a positive greater than 1 ratio for current ratio. And I'm seeing that. Current assets over current liabilities, Devon's 1.09, Woodside's 1.41, Coterra's 1.66. They're all fine. Of course, I like to see a bigger number, but you look at all these metrics. Long-term debt over total capital, I don't like to see a ratio too high. 36% is very manageable for Devon. Woodside, it's very manageable, 14%. Coterra, 16%. Let's move on. Cash flow, by far, it's Woodside and it's Devon. Okay, but I got to tell you, Let's go back to the dividends. I already talked about them. I'd say they're number one. So, what are the major takeaways here? Devon Energy, they're an independent energy company. They explore for, they develop, and they produce oil, natural gas liquids in the United States. Performance of these companies is cyclical and is dependent on the price of a barrel of crude oil. Okay, specific to Devon, total return and growing dividends is critical to investors. Okay, that's critical. The price of crude oil as of yesterday is $73.67. It's down about $10 since the beginning of the year. Some of the experts, we talked about the gentleman on CNBC, he's predicting a steady increase in the price of oil. And Devon knows this, and they're going to manage to this. They have the best PE ratio, in my judgment, of their peers and competitors. They got the best 3-year total return. Total return, remember, is price and dividends. They have among the best 5-year dividend cagr of peers and competitors. So it's the dividend compounded annual growth rate. That's really the shot in the arm that these companies give to their dividend yield to kickstart it and to kick it into high gear. That's really important. They are continuing to pay out special dividends to shareholders. That to me is critical. Most companies aren't doing this. So instead of getting 4 dividends, you're getting 8. Absolutely. And you know what? You want that. You want that to grow your dividend holdings and your snowball. Very, very important. They have the best return on equity, the best return on assets, and the best return on total capital of their peers and competitors. They have among the best cash flow from operations of their peers and competitors. And folks, that's it. That's why I invest in Devon Energy. So I'd kindly ask you to give us a like. And if you're not a subscriber already, subscribe to us here at Dividend Blasters and share this video with a friend or a family member. Until our next video, have a wonderful day and God bless.